This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's finally a Friday. End of the week. We are coming to you live as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleague Surabhi and Nigel. Morning, guys.
Good morning, guys. Smiles couldn't be wider, right? It's a Friday look. We all wear it no matter what. Markets can go up and down and all-time highs can wait. But it's a Friday. That's what matters.
And next week's the truncated week, as I informed you earlier as well. I'll tell you, Prashant, it's going to be extra special because our co-anchor is going to be celebrating her birthday as well. One day before that.
So the treat is on Tuesday.
Oh,
absolutely.
God.
Or Thursday.
The treat is on Tuesday, and we can celebrate. So I just thought
Wednesday's a holiday, right?
That. Absolutely. You're making it more interesting now.
So Surabhi, happy Thursday and happy Friday now. So
Yeah, it's happiness all the way.
all right. Well, will the markets be happy? That is the question, right? And I think let's kind of lay out the cues as they lay for you this morning. Yesterday, by the way, once again, we faced selling at all-time highs of 18,888, 87.60. So I'm rounded that off to 18,888. So, I mean, this is not the first time this is happening. We got to, by the way, the closest we have so far till the all-time high, which was last made in December of 2022. We came within 1 point of that. Now, overnight, we got some supportive cues. Basically, Wednesday's selling was completely reversed. So it largely came through from the tech universe, tech stocks in the US. So NASDAQ actually was the biggest gainer. It ended about 0.95% higher. But the Russell is still underperforming. Market breadth was 2:1 in favor of declines. So this is a kind of a divergence which we pointed out almost a month ago, which still continues. There were some hints, some evidence that the market rally in the US is broadening out, but that is kind of stalled. So while, S&P and NASDAQ are higher, will that feed through in any significant way? We'll see. The Bank of England surprised. It was a shock hike of 50 basis points. Yields in both Europe and US reacted very significantly to the Bank of England decision, but then it cooled off. But the 10-year in the US still ended about 8 basis points higher. The other significant price change from global markets worth noting is oil, which is sold off 4%. And this is Brent oil, which is now back to $74. I don't think anyone will complain. Of course, India being a very large importer. Now, just to go back to the Nifty. So signs are there that maybe the market is kind of distributing at higher levels and there is some selling which is starting to emerge. But I would say that because the thing to do to make money if you're a trader intraday has been to try and buy the dip, and it has worked for so long, without kind of writing off that the market's finally turned and it's heading lower, I would say we perhaps need a little more confirmation to kind of say conclusively that for now maybe the uptrend is turning into a bit of a pullback. And how will we confirm that? A break below 18,660. Which is about 100 points away from where we left off yesterday. 18,660 because that is Tuesday's low. It is, by the way, this Tuesday's low. It coincides with last Thursday's low. It also coincides with the 20-day moving average. All three kind of converge at that 18,660 levels. So you get a sort of break below that, a close below that, and I think then we will start to talk about perhaps a more deeper, meaningful kind of pullback. Otherwise, it just may be limited to, a couple of days of sideways, slightly lower kind of price action, and the market pulls right back. Something which we saw with the Nifty Bank, which again, like the Nifty, came within, 1 point or something, and then, sideways for a week and a half before making a new high and taking those highs out. For the Nifty Bank, for now, it's looking like a slightly more corrective pattern. The 40-day exponential moving average for the Nifty Bank is important. That stands at 43,498. And that is the level which we need to watch out for. On the way up, 44,042 to 44,083 is the resistance zone, the resistance area, which I think the Nifty Bank needs to take out. So those are levels, very near term. I would again say, and I've said this mostly all of this week, watch for the first hour and a half. The market is giving you signals that maybe it's getting a little tired. Even if, on days like, when it looked like perhaps we could hit the new high and take it out, even on those days, it's looked a little tight. It's not been a, euphoric, strong push through those levels to take out, the high. So watch for the first hour and a half before you decide what to do. The SGX is indicating a 15-odd point lower start. The other sector to watch is the IT services sector. It was under pressure yesterday. Accenture reported numbers, and I don't think that does anything for the IT services stocks. At least from their guidance, it looks like they're expecting demand for IT services to be a little muted. Surabhi.
Well, Prashant, absolutely. In fact, I was looking at those numbers. I'll come back to Accenture in just a bit. But first up, the Asian picture. We'll pull up the Hong Kong Hang Seng for you. But markets around Asia are down. China's, of course, shut. But even Japan, Singapore, most of these markets are down over 1%. And the mood seems to be a little somber because central banks have, put out their message loud and clear. And the message is, we are not done yet. So markets around the world that were hoping for a nice, easy-peasy second half, maybe some rate cuts thrown into the mix, a nice end to 2023, that seems to be now getting priced into the reality. And those rate cuts are getting pushed off the table, at least maybe for this year. It's not a done deal yet. It's very, very clear. So what happened yesterday, Prashant alluded to this UK hike that we got. It was a bit of a shocker for the markets because the expectation was 25 basis points, that too with just a 60% probability. What was delivered was 50 basis points. So it was a loud blow coming in. And perhaps you can't blame the BOE, right? Because inflation is running red hot in the UK. The last print, CPI print, was 8.7%, with core inflation, in fact, accelerating month on month to over 7%, 7.1% core inflation in the UK. And the BOE was like, markets can want what they want, but we need to look at bringing inflation lower. What did the Swiss National Bank say yesterday? Now, SNB's hike was on an expected lines, 25 basis points. But once again, in the commentary, the Swiss Central Bank again reiterated that more hikes will probably be warranted as we look at the rest of the year to bring inflation down, to ensure, quote-unquote, price stability. So central banks are not done yet, and that's getting priced in markets pretty much around the world. Of course, Wall Street had a bit of a flip up, last night. But if you go back to the larger point, for India, Prashant, also why perhaps Accenture is not the best headline to have, and even TCS, by the way, is because IT has been the outperforming part of the market this week. And IT has done really well. I mean, just incrementally, we started seeing accumulation at lower levels, but now, comes in this. So, okay, just a quick word on Accenture. The revenue for the quarter gone by was up about 3%. The US revenue for the company has fallen to a 3-year low, just the pace of growth. It's down to a 2% growth in the US. And Accenture is also saying that small deals are getting withheld, clients are holding back. So it's commentary that we have heard before, from the Indian folks. The outlook is growth of 8 to 9%, full year outlook, that is in local currency terms. Now, what was I saying on TCS? This is a Mint report right now, and of course, we are awaiting independent verification. But it seems like there's a whistleblower who's gone on and written an email to the top management saying that there is a bribes for loans, scandal, quote unquote. So, 4 employees have been sacked as per the Mint report. So anyway, the headline, the sentiment is not very, very positive on IT as we start off. The Nifty IT, as I was saying, was up almost 1% this week, outperforming the Nifty, which is why this news, let's see if it starts triggering some sell down over there. So we'll have to watch out for IT. This was a strong pillar of support till now. And today the news flow is not very positive. Flows are mixed. FPIs were net sellers to the tune of almost 700 crores. The domestic institutions bought about 200 odd crores. And finally, for the week as well, this is a week where the mid-cap sentiment at an index level has been sobering. You can't take away from that. And let's see if we have more of that or not. Individual stocks are still flying, but at an index level, the Nifty is down 0.3%. The outperformance gap between the Nifty and the mid-cap or the micro-cap and the small-cap, that is depleting. Look at the Nifty small-cap, flat for the week. The Nifty mid-cap is barely flat, 0.2% higher. Micro-caps are still flying. But I guess, Nigel, safe to say that overall the sentiment is cooling off a little bit. Maybe not too bad because it's been a fantastic mid-cap party, right? So maybe just a breather, take in some air, drink some water, and then come back for round 2.
Yeah, good you mentioned water, given that it's a Friday. But, yesterday we almost got there, right? We were within a point of getting to those fresh all-time highs. So the Nifty is trying but not yet succeeded, though it still appears a matter of time before we get there. Those are the last 5 days highs, so close, in fact, to hitting that 18,888 odd mark. But make no mistake about it, yesterday was a Thursday. So part of the fall that we saw in the final hour of trade was because of the expiry-related factor. Just take a look at that. The Nifty, lowest point of the day, the final tick. The Nifty Bank as well, lowest point of the day, final tick. Normally we see sometimes, On the next day, some part of that underperformance or outperformance gets reversed. So let's see whether or not that happens today. But the Nifty's got a task on its hands. I'll tell you why. Because today is a Friday. It's going to be ending the week. And we need to put in close to around 55 points if in case we need to maintain that winning streak. The last 4 weeks, the Nifty has been higher. Now to get it to 5 weeks in a row that we're likely to end higher, then we need to put in 55 points for today's session itself. So record highs can wait, but you want to maintain this record at least. The 5-week winning streak is hopeful. That's at least what the bulls will be looking at. The last time we saw a 5-week winning streak was in July and August last year itself. My colleague Hormoz, in fact, was helpful enough to tell me about that. The last time we saw it was in July as well as August. So 55 points, those are the runs that we need to get today to maintain that streak. What did the FIs do? They added more longs than short positions in yesterday's trading session. And I'll tell you what, we're missing their shorts in the system because now the markets are net long. If you had more shorts in the system, we would already been at those fresh all-time highs. What are the levels we're looking at? 18,660, 20 DMA, the lows that we saw in the past couple of days as well. So that becomes the important support. Till we're holding on to that support, you need to be long on the index itself. Once we breach that support, then in fact, we'll review that. Resistance, 18,920, I'm going by the options data. And around 18,920 odd should be a bit of a resistance zone. For the Nifty Bank, well, it's still stuck in a range between the 20 and the 50 DMA. You're hoping that, in fact, on the downside, the 50 DMA continues to hold out. Multiple times we have gone there in the last couple of weeks or so, and we have held on to that mark. So 43,450 needs to hold out. If that holds out, then you're optimistic that we finally get past that 44,000 odd mark. For starters, the SGX Nifty is now indicating a bit of a flattish to a mildly negative start. We could dip a little bit more, I think so, but you need to remain long on this index and hold that 18,660 odd. Task on the hand is today is to maintain that 5-week winning streak. So let's see how this goes.
All right. Well, we'll see how that goes. And, it's going to be a flat start if SGX is anything to go by. Let's get you what some views we are getting. So this is on money markets. Lakshmanan V of Federal Bank says the dollar index was seen pricing in the U.S. Federal Reserve Chair Powell's hawkish testimony. 50 basis point high from the Bank of England and Norway Central Bank each, and thus breached 102 levels briefly, resulting in the pound and the Canadian dollar trading the highest levels this year. He says the rupee finds itself caught between weakening US dollar and declining Asian currencies, particularly the yuan and the yen, which are trading at the lowest levels of 2023. He anticipates the dollar-rupee pair will trade within a range of 81.68 to 82.35 during the next few trading sessions.
Okay, and on bonds, Lakshmanan V says the bond market has moved from consolidation zone of 6.95 to 7.05% after the Fed indication of further hikes. He says global central bank action has delayed the possibility of rate reversal by MPC by at least 2 quarters, thus adding to the bearish sentiment. He says the slow onset of monsoon is also raising concerns over El Nino effect. Thus he adds 7.12 for the benchmark bond yield will be the immediate support zone.
Well, a lot of stock-specific action to track for you, and we'll get to that in just a bit from now in our special Top 10 segment. For the time being, let's run you through the list. We're looking at BPCL, LIC Housing Finance, Delivery, and HCC. Their stocks on the back of positive news flow. While on the flip side, you have IT stocks, Orchid Pharma, SBI Cards, Craftsman Auto, Sincera, as well as ONGC. Their stocks that could be reacting to negative news flow.
Okay, Richard Harris is now joining us. He's Chief Executive of Port Shelter Investment Management. Richard, good to have you with us here. Thanks very much. Are global markets going to continue to do very well, Richard? What's the chance? I mean, US specifically, let's start with that, where the Nasdaq is up 30% for this year, whereas I think the S&P is far behind. If you look at an equal weighted S&P, that is actually, I think, absolutely flat for the year. I mean, I'm talking about equal weighted market cap wise. But of course, because of the large contribution from large cap tech stocks, even the S&P is up about 9 or 10% for the year so far. But do you think it'll broaden out and we'll get more rallies here?
Well, it's difficult to say because, of course, the reason those particular stocks have done well is the AI narrative. And the AI narrative has really meant that stocks like NVIDIA and the Googles and the Apples of this world have done actually very well because they're seen to be particular beneficiaries of AI. If you look, in fact, it's interesting, if you look at the other end of the market, something like 30% of stocks are below 10 times. So you've got this massive diversity in the market. And yes, you're quite right. the market really, if you look in different measures, has flattened off a lot. But, a profit is a profit and it makes people feel good. And I think the AI narrative will continue for a little while, but it seems difficult to see with something on such a long-term spectrum that it's really going to be sustainable.
Richard, hi. Good morning. So, what we're also seeing is central banks sending out a pretty loud and clear message, right, that we're not done yet. And we're seeing that from around the world, whether it was Australia earlier or Canada, now the Swiss National Bank or the BOE yesterday. So what's your sense? I mean, how soon can the markets price this in? Because just about a month back, there was a lot of expectation of perhaps rate cuts this calendar year itself. Is this a new negative for equities, or can equities take it in their stride, thinking that, okay, maybe it's an indication of underlying economic strength?
I think that the interest rate threat has always been there and it's continuing. I think what has surprised people is that we've seen a lot of strength, say, in labor markets, because people want labor and there are various reasons why that's the case. But we've seen a lot of strength there. We haven't seen the kind of recessionary unemployment that we might see. We have seen recession in a few countries already, technical recession in Germany, and yet the labor market has remained relatively strong compared to how you'd expect it. So it is an unusual situation. We have interest rates going up. We have the economy still quite strong. We have labor markets still relatively strong. And all of that is producing a series of narratives that's really confusing the actual picture that we often think is so simple. I think one of the key elements in this is the fact that there's still a lot of liquidity floating around after COVID. If you look at how the markets have done since the high just before COVID, they've actually done extremely well, almost whichever market you look at. There's been no real improvement in global economies. We've had a major war come through since then. And I think the real answer is the fact that so much money was created during COVID to try and prevent economies going into recession, that money is still flowing through the market and looking for good ideas to invest in, of which AI is one.
Hi, Richard. Good morning. Nigel on this side. Richard, the last time around we chatted, you were telling us the preference, I think, to India in comparison to China. But when you're approaching equities, could you tell us where does India feature? I mean, with regard to developed markets versus emerging markets. And from the emerging market basket, India is still the preferred market for you?
Well, I think, in fact, since we talked last time, and you're always very good at catching me up on this, which is very healthy for an analyst, I think the issue is that the picture with India actually looks even better. One of the most positive factors, I think, with the Modi and Biden talking recently, this is an opportunity for India, not that they necessarily need to go under the American umbrella, but any improvement in trade, any smoothing of a relationship has got to be good for India. In their non-aligned position, obviously they're able to take advantage of discounted oil from Russia, because Russia, let's face it, is a distressed seller at the moment. And if they can develop this relationship with the US to improve relations, especially economically, I think that will be very positive. Of course, there's always a little bit of a cloud in the silver lining. The key thing, I think, is that India really has to grasp this opportunity wholly, and very often infighting will tend to restrict it. But to my mind, that's probably one of the most favorable indications that a foreign investor would have towards the Indian market at the moment.
All right. Okay. Got that, Richard. Thank you very much for giving us a quick perspective on how you're reading through the cues as we see them right now. Thanks for joining in. We do have to take a very quick break on that note. On the other side, our list of top stocks to watch this Friday morning. Welcome back. Asia is down and out. Color this Friday seems to be red, and the SGX Nifty is actually better than the regional markets, you'd have to say. At least it's flat. The markets are sliding 1%, 1.5%, so maybe not too bad looking at the SGX. By the way, this index is going to be trading in the gift city very soon. July the 3rd, we'll be talking about the gift Nifty and no longer the SGX Nifty. Anyway, we'll get to stocks now. Our team is standing by with the list of top stocks to watch out for this morning. Well, hi guys, happy Friday to all of you. Let's start first with the IT headlines, which are not so sanguine. Mangalam, tell us some more.
Well, they're not so sanguine, but at the same time, it's nothing new that we got from Accenture's numbers as well. The revenues were up 3%, yes. The operating margin came in at 14.2%. This compares with a number of 16.1% same time last year. The new bookings came in at $17.2 billion. They've expected the FY23 outlook, revenue growth of anywhere between 8 to 9% in local currency, with operating margins no improvement from what they saw in the previous quarter. However, brokerages on this say that, there is some concern around dampening of small projects. We have some concerns for Indian IT. While they, maintain their cautious stance in the first half of this year, they believe that there is a possibility to accumulate these companies at current levels as well. Similar is the case with Nomura. They say that, Accenture's top end of revenue guidance has been cut again. There are no green shoots of demand recovery in Accenture, and which is why they have a cautious stance, but they have selective stocks that they like. Case in point, something like Tech Mahindra and Coforge as buys. Remember, the IT index yesterday was one of the top losers, down almost 0.75%. So some part of the street was positioning itself for weakness in commentary. See the IT stocks to open in the red, but the question is whether they recover in the second half or not.
Okay, all right. Mangalam, thanks a lot for that. Well, we'll also connect with Manik Taneja of Axis Capital in a short while from now to discuss the IT space, Accenture's numbers, and also its impact on Indian IT companies. Time to move on then. Vivek joins in to tell us about Orchid Pharma. They're looking at raising some money. Morning, Vivek.
Well, good morning. Important development as far as Orchid Pharma is concerned, looking to raise significant funds. So now, the QIP has been launched to raise almost 400 crore. The 400 crore is the 300 crore of base size and another 100 crore of an upsize option. Now, the indicative floor price for this particular issue is at 403.9 rupees a share, which is as per our sources. And the SEBI floor price actually works out to 425 rupees a share. So it appears to be a discount even to the SEBI floor price. The equity dilution at this particular fundraise works out to almost 25%, 24.2% to be precise, of the pre-issue outstanding equity share capital, going with the red on the back of the fact that, there's a significant equity dilution and the floor price seems to be below, what the current market price is.
All right, thanks very much for that. That's Orchid, and we'll keep that on the radar. Now, SBI cards, this is the latest monthly data for card spending, which we have, and SBI cards is the one we're focusing on. Abhishek has got all the details. Abhishek, morning.
Morning, Prashant. So begin with, for the sector as a whole, the credit card in force, that grew by 14.1% on a YOY basis and about 1.4% on a month-on-month basis. Total spends grew by 23.7% YOY and about close to 6% on a month-on-month basis. So spends per card grew by 8.4% YOY. This growth rate of 8.4% is perhaps the lowest in last 6 months, and it grew by 4.4% on a month-on-month basis, which is pretty strong. For SBI card, the total spends grew by 12.1% YOY, but it is declined by 2% on a month-on-month basis. So versus industry growth of 5.9% month-on-month, it has actually declined for SBI card. So spends market share has dipped sharply to about 16.9% in May when compared to 18.65% on a YOY basis and about 18.2% when compared to the April's market share. Total cards in force grew by 21.1% YOY and about 1.7% month-on-month. So cards market share over there, they continue to gain momentum. It was at 19.5% in the month of May, which compares to around 18% on a YOY basis and about 19.2% on a month-on-month basis. Per card spends, that grew by 52.8% YOY, but has declined sharply by 3.6% month-on-month. So analysts say that corporate spends might have impacted the spends momentum this time around for SBI card. Back to you.
Okay, so some decline in spends on a month-on-month basis for SBI. Thank you, Abhishek, for that. Some more stocks in focus. We have Sonal standing by, BPCL, and I think even LIC. Why are you watching for these two, Sonal?
Well, let me start with BPCL. They have a board meet on 28th of June. This is for a fundraise that the company is planning. Interestingly, it's for energy transition and new ways of energy generation as well that the company is talking about. It could be via rights issue or other modalities as well. So that stock definitely remains in focus. For LIC Housing Finance Company, the board has appointed T. Adhikari as Chief Operating Officer. This is with effect from 22nd June, that is yesterday. So that stock is on our radar as well.
Okay, all right. Thanks a lot for that, Sonal. Well, a lot of block deals took place yesterday. Vivek as well as Nimesh, they've been giving us heads up on a few of them. Vivek, take us through the list and how you expect stocks to react.
Well, good morning. Yesterday we saw 4 large block deals happening. First on our list, we'll go through Delivery, Carlyle, CS Swift Investments exited their complete stake, almost 2.5% stake at 385 rupees a share. And, Norges Bank, on account of the government petroleum fund, bought almost 40.6 lakh shares. On the other hand, Craftsman Auto, you actually saw the promoter pairing stake in the company. So promoter Srinivasan Murli sold 3.8% out of the total 9% that he holds in the company at around 3,960 rupees a share. Goldman Sachs picked up 2.4% of the total equity, and Axis Mutual Fund 2 bought almost 0.6% over there. HCC, yesterday, close to market close, you saw a very large block deal happen over there. 3.1% of equity changed hands. So Asian Opportunities Mauritius Limited sold 3.1% of the total 7.6% that they held in the company. Achintya Securities was one of the major buyers, picking up almost 79 lakh shares over there. Sansera Engineering, you saw almost 14% of equity change hands in that particular counter yesterday. So, two promoters, Client, Ebin Limited, sold 9% of the total 18% stake they held in the company. And another, employee fund sold almost 5.1% of the total 10% stake that they held in the company. Out of that, Kotak Mid-Cap Fund picked up 3.6%. ICICI Prudential Mutual Fund picked up 1.1%. So, all of these blocks, most of them got absorbed. It'll be interesting to see whether there is follow-up buying or selling in these names.
Absolutely, yeah. The blocks are being bought also by institutions, whether mutual funds or others. So that's the sign of hectic deal activity. Thanks, Vivek, very much for that. So those are some of the key stocks to watch. But crude is a big queue as well, including for a lot of the oil refining and marketing companies. Manisha is joining in. Manisha, morning. What a slide, 4%, and it's still down. I mean, Brent even this morning is down about another 0.4%.
Oh, absolutely. And it's erased all of these week's gains. Until yesterday, we were in the positive for this week, but after 4% of decline, we are in the negative. And yes, this is how, this is a hawkish central banks, and that really seems to be weighing on. Because when you look at the U.S. inventories data yesterday, we saw a slide of 3.8 million, and that should have been a supportive factor, but that wasn't really the case because the way the central banks have been, apart from U.S. suggesting that another 50 basis points is coming in this year, you've seen that surprise move come in from Bank of England. That shocked the market. A 50 basis point rate hike coming in from UK now takes those rates to 5%. This is the 2008 highs for UK as well. And apart from that, you had Switzerland, Norway, Turkey, all of these central banks also hike rates much more than what the street was anticipating. So it is more macro than micro that really seems to be impacting crude oil prices right now. Most market chartists tell us that until the Chinese demand doesn't pick up, and that, by the way, has been yet another disappointment, the 10 basis point rate cut hasn't really worked well for the markets. There is much more that China would need to do. Until that comes in, we are looking at further pressure continuing for the crude prices.
Okay, all right. Thanks a lot for that, Manisha. Well, a quick recap then of all the stocks we just discussed. Stocks with positive news flow include BPCL, LIC Housing Finance, Delivery and HCC. While stocks with negative news flow, you have the IT stocks, Orchid Pharma, SBI Cards, Craftsman Auto, Sansera, as well as ONGC. Well, a lot of brokerage notes came in earlier today as well, and Surbhi is joining in to run us through that list with all the notes for the day. Morning, Surbhi.
Morning, Nigel. So first on my list is Bajaj Auto. So JP Morgan has written on a Bajaj Auto with an overweight rating and a target price of 5,400. They say it remains one of their preferred picks due to some of the reasons they've mentioned are they see two-wheeler and three-wheeler exports to be bottoming out. They see domestic recovery in the two-wheeler segment. The EV volumes have also started picking up, and they see improving margins due to better mix. Next on my radar is the real estate space. Now, Morgan Stanley has written on it market, and they say the property upcycle is now well entrenched. The listed developers are well prepared with the new launches and execution capabilities. The balance sheets have been repaired and valuations have risen above the mean levels. They have an overweight rating on DLF, Phoenix and Shobha, an equal weight rating on Oberoi, Macrotech and Godrej Properties, and in their REIT space, Nexus, the recently listed company, is one of their preferred picks.
So, Ruby, thanks very much for that. We'll take a very quick commercial break here. We'll have Siddharth Khemka of Motilal Oswal Financial Services for a quick fundamental check. We'll discuss specific stocks. Later, we'll have Manik Thaneja of Axis Capital to talk about the IT services sector in light of the Accenture results. So stay tuned. That's the conversation coming up in a bit.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good Friday morning. Well, a lot of stocks to discuss, and to help us out with that, Siddharth Khemka, Head Retail Research at Motilal Oswal Financial Services, joining in. Hi, Siddharth. Good morning. Thanks so much for joining in. And just a bit as well, we'll be joined by Manik Thaneja to discuss the IT stocks. Siddharth, before we get to Manik, you tell us, what's your view on the IT stocks? We have Accenture's numbers that came in overnight, and there is signs of softness even on pricing as well. What's your view on the stocks and how do you approach them?
Yeah, very good morning, Nigel. Thanks for having me on your show. So I think it was the Accenture numbers, especially on the guidance side, is more or less on the expected lines. We are not expecting very strong commentaries after what some of the other IT players have been highlighting. So clearly, while the Q3 numbers were decent with a revenue growth of 5% on a constant currency basis, the company has lowered the guidance by 100 basis points to 8 to 9%. And that could be a negative read-through for the other Indian IT peers, given that the management has highlighted that demand environment continues to remain weak because of adverse macro environment, delays, especially in the small and discretionary deals, while large deals continue to do well. And they have also highlighted that there has been some dip in pricing in few segments. all of which could be a drag, at least on the near-term outlook for the other Indian IT players. North America continues to see more impact, and similarly in terms of segments, BFSI, CMT are more impacted. While the only silver lining that we saw from the entire commentary was that the momentum in the managed services is good, and that is expected to continue in the fourth quarter for Accenture, which is a positive read-through for TCS and HCL Tech. So barring that, I think in the near term, we heard the recent Coforge management analyst meet as well, where they clearly highlighted that H2, the recovery that a lot of people are building in may not happen to the extent that people are expecting. So overall, I think the sector would remain under pressure until the macro environment and the growth visibility improves.
Okay, all right. So that's what about a couple of other stocks, that y'all have been tracking? I think Blue Dart is something that as a house you'll be positive on. Give us the rationale out there, and how do you expect the stock to perform from here on?
Yeah, so Nigel, if you look at Blue Dart, the company enjoys 60% market share in the organized air express segment, and the company is also looking to enter into the surface express. While in FY23, the Brent crude prices fell, ATF prices did not come down, which led to some margin pressure. But however, now the ATF prices have started correcting, and it's one of the biggest cost, almost 40% of direct cost for Blue Dart. So that is a big positive for us, which has now we expect, because of which the margins to stabilize in the 13 to 14% range. Also, Blue Dart has added 2 new aircrafts to cater to the emerging segments in the tier 2, tier 3 cities, which we see that should cater to the healthy demand growth in the long term. And hence, we are expecting about 12% volume growth. And overall, if you look at the valuations, the stock, although has recovered from its lows, is still 30% lower compared to its October highs. And on back of almost 14% revenue growth and improvement in margins at 26% PAT growth, we believe the stock could do well from here on. We have upgraded stock to buy with a target price of 8,040.
Okay, so that's a positive take on Blue Dart coming in. One of the sectors that obviously will be dominating the action today, which will be in center focus, is the IT space. And that's because of the results that we got from Accenture and, more importantly, their guidance. Now, interestingly, Nifty IT has been the outperforming sector this week, which is why this is coming at a pretty critical, interesting juncture. For instance, TCS is up 2% for this week, outperforming the Nifty. You can see, that's the 7-day chart. Actually, if we look at a week to date, then it will become very clear. Monday to now, the Nifty IT is up about a little over 1%, whereas the Nifty is more or less flat. That's a 7-day performance. Okay, let's go forward and discuss this with Manik Taneja, Executive Director, IT Services at Axis Capital. Manik, good morning. Thank you for joining in. So, a lot of people are reading into the Accenture commentary because they're talking about deferrals in small deals, and that's being taken as a key negative, especially for the Indian players. But what would you say? And also the fact that, I was looking at the US component of Accenture's revenue, which has grown just 2%, and that's the lowest growth in, I think, some 3 years. So what's the read-through, and should we be concerned here in India? And if so, then for what category of stocks?
So, first of all, thank you for having me on the show. And I would say there is always a limited read-through from Accenture results. And Accenture results are essentially confirming the trend that we've been seeing even for Indian companies over the past 6 to 9 months. So even if you look at the Indian company results, essentially, it's basically the growth from US which has been dragging overall growth. And it was no different for Accenture. And the second thing that I would essentially point out is that amongst the verticals, there is broad-based moderation. And for Accenture, consulting business essentially has slowed down from a 30% year-on-year local currency growth 12 months back to about a minus 1% local currency growth in the reported quarter. Managed services / outsourcing, which is the real comparable for Indian IT, has held up well, even though even over there, the growth moderation has happened over the course of last 12 months. Now, answering your question with regards to how should one be reading the commentary on some of the smaller deal flow. I would just say that companies would always get some natural flow of business with existing customers, which are extensions rather than deals that would generally be reported. And it is over there that almost all companies are reporting pressure. And that's the reason why the near-term outlook across companies is much more modest. This dynamic, I would say, given the higher dependence of North America for tier 2 companies, that's where it raises more risk. But I would say, rather than painting it with a broad brush, I would say, given the current environment, some companies will hold up much better, and that's true both for the larger companies as well as for the smaller companies.
All right. Hi, Manik. Good morning. Nigel on this side. Good to hear your thoughts. So, Manik, I was looking at the CMT, that's a communication, media and technology part of their business. There was, I think a little bit more weakness out there. And Tech Mahindra, I think, has the highest exposure to that space. Would you view it negatively from year on for that company? I mean, given that CMT was weak, which company gets impacted the most?
Sure. So I would say for Accenture, within that CMT, you also have the high-tech customer base and the media customers. And those are the customers which are hurting more given whatever you've been picking up in terms of the news flow, in terms of headcount rationalizations that have been undertaken by some of these high-tech customers. In case of Tech Mahindra, the communication vertical is much more heavy in favor of the TSPs, and thereby I would not draw direct inferences in terms of a complete impact or a similar performance for Tech Mahindra in the communications vertical.
Okay.
Manik, just another question. I mean, earnings season is still some time away. But the last quarter was marked by this huge divergence between what the large cap companies reported and how they were speaking and their body language and the way mid caps are flying. I mean, a lot of mid cap IT companies actually reported very good results. Now, given what what Accenture is saying, and they're talking about, this deferrals in small size deals, could that have a bigger impact even on the mid-sized companies here in India?
So, Surbhi, even amongst the mid-tier companies, you are essentially seeing a mixed performance in the March quarter. So companies like Mphasis have struggled. Companies like LTI Mindtree, which I would say somewhere between the mid-tier companies and the tier ones, have had tepid growth. And I would say that the performance is likely to be in a similar fashion if I'm thinking about the next 3 to 6 months. Some companies will still sustain reasonable sequential growth, while others may struggle. I think it's a function of both your underlying strength of the business, strength of your customer relationships, and the customers segment that you're exposed to.
So very quickly, Manik, last 30 seconds, let's come to the stock calls. I believe you like HCL Tech, but you have a reduce on Infosys and TCS. Just quickly explain that to us. And what would be your top picks, if any, across the spectrum, mid-cap or large cap?
So amongst the tier ones, our preference has been with HCL Tech over Infosys and a TCS. And there is significant outperformance that you've seen over the course of calendar year 23 year till date in favor of HCL Tech. Given the relative outperformance, I would say some of the absolute upsides may be limited for HCL Tech as well. And amongst the tier 2 names, our preference essentially has been with Coforge and then followed by Mphasis. Coforge is a company which should continue to do very well in terms of both growth and margins through the near term, with some tailwinds from the way their European exposure is and the way currencies are behaving. And Mphasis is more of a valuation call, while from a number standpoint, they might continue to struggle.
Manik, hi, good morning. Sorry, just a little unrelated, but do you have coverage on Cyient?
No, that's not a name that we cover.
Okay, all right. There's a new IPO, there's a subsidiary which is making it to the market, IPO. Cyient DLM IPO opens on the 27th. They're raising about 600 crores. According to the RHP, we had the management with us yesterday. So that should be an interesting one. The Cyient stock itself has done phenomenally well, 1,500. Manik, it's a pleasure. Great to have you with us here. Thank you very much for joining us on the program.
Thank you.
Well, we'll take a quick commercial break here. There's 15 minutes to go for the pre-open session at 9 a.m. Anuj will be here with a quick trade setup. We'll get you the top stocks for the day with our technical and F&O experts coming up in just a second. Okay, welcome back. There's 13 minutes to go for the pre-open session. SGX is indicating a 30-odd point lower start. Anuj is here in the studios with a quick check on things. Anuj, morning.
Morning, guys. Friday today, so obviously there's a bit of a cheer, though the market yesterday saw a bit of a decline, but that's okay. I guess, I'll still give benefit of doubt to the market for 3 reasons. One, there was weekly options expiry and the market was close to highs, so that's okay. Reason 2, like we discussed yesterday in closing as well, that perhaps the market also preempted that this Korea factor, that it won't be included, and that's why maybe you're already preempted that decision yesterday itself in last hour. And of course there was profit taking in leading stocks. Keep an eye on the mid-cap action, because that's where you saw the first sign of selling yesterday. After a really long time, we've had falls in the Nifty, but the mid-caps have been quite stable. Yesterday was the first day where the mid-caps actually led the fall during the day. So I think that's something to keep an eye on. For the Nifty, the zone I'm watching out for is 18,700 to 18,750 and then 18,650 to 18,700. You want to look for stability in either zone 1 or zone 2, and more importantly, stability in the advanced decline. Once that happens, perhaps the market can give you a long trade. HDFC Twins are very strong. Today we'll see, of course, IT and see how things move here, Reliance and ICICI Bank. On the Bank Nifty, well, it's really been stuck at higher levels. Look at the highs of last few days. 44,070, 44,083, 44,040, 44,042. And basically it's in a range. It's in a range of 43,350 to 44,050. If you're able to play up this range smartly, we are right in the middle of this range. Good for you. Otherwise, perhaps stay on the sidelines till this range breaks out or breaks down.
All right. Thanks very much, Anuj, for that. So that's, by the way, we are always cheerful, right? You said that it's a Friday, so...
Friday we're double cheerful.
Especially on Friday is special, Prashant.
Yesterday we had Happy Thursday, so we will tell you.
And then Friday is just happier. Nothing beats Friday. Thursday can try and get close to it.
Should we treat it...
that's on Tuesday.
That's on Tuesday, Surabhi's birthday.
And
Wednesday is a holiday, so we're sorted.
So celebration...
Next Wednesday is holiday?
Yes.
Yeah.
Oh, wow.
Most important cue, Anuj.
And your birthday is on Tuesday?
Yes.
And my birthday is on Tuesday.
Okay, so Tuesday is sorted.
Yeah.
And then maybe Thursday as well.
Oh, gosh. Oh, okay. Yeah.
Anuj, thanks very much for that. Well, so that's some cheer. Siddharth is still with us. Siddharth, thanks for staying on. Just a quick word on, what the house view is and what kind of flows did you see yesterday, for example, especially on mid-caps and small caps? Because as Anuj was pointing out, yesterday we did see some fall, some pullback. I mean, actually, small cap index, I think, was down a full 1%. Otherwise, it's been uninterrupted 1% CAGR daily compounding on the upside. Yesterday, we saw a little bit of pullback. What do you make of it?
Yeah. So Prashant, definitely, I think the mid-cap, small-cap party had been on for quite some time, and yesterday it coincided with the weekly expiry, but we did saw a lot of profit booking in names which had seen a kind of run up in the near past. So, for example, NBFC as a space which is still expected to do well in the coming quarters on back of the pause in the rate hike and the expected rate cuts by the end of the year, and the stocks had started seeing a lot of run up. So some profit bookings were seen there. So we're not seeing any panic as of now in our desk, but I think it's a healthy correction. People are definitely nervous with Nifty unable to get past its high. So it's like the nervous 90s where it is taking a lot of time to cross the psychological level. And I think once it does that, the market confidence will come back, because a lot of other indices have managed to do that, be it Bank Nifty, be it the FMCG index, be it the mid-cap, small-cap indices. They are all trading at their all-time highs. It's just that Nifty is still remaining to cross its December highs. So overall, I think the view or the sentiment continues to remain positive. People are looking at booking profits at regular intervals just to be on the cautious side. But overall, as I said, the outlook remains positive for the mid-cap, small caps.
Okay, positive on the mid-cap, small-cap outlook. Got that, Siddharth. Well, we are rounding up very close to 9 o'clock, so let's bring in our technical experts. As usual, Mitesh and Shrikant are with us this Friday. Gentlemen, good morning. Thanks for joining in. So it's been a bit of a slippery slide for the Nifty, right? Let's start with the index and what are the boundaries you're watching out for and whether you'll actually take any trade there. Mitesh, let me start with you. Any trades on the Nifty?
Good morning, Survi. I've been actually avoiding trading the index for the last 5-6 sessions purely because of the fact that my belief was that we'll not see a strong up move in the Nifty, and I think main reason was the bank Nifty not participating on the upside. So broadly, it's a sluggish market which is still chopping around within a range. 18,650, 18,850 are my counters, given take 10-20 points. But broadly, it's a 200-point kind of range for the Nifty, and about 44,400, 450 to about 43,500, 400 on the downside, about 1,000-point range on the back Nifty. So having said that, I think the index will still remain the same. Trading is stock specific, though I think, yesterday there were some mild signs of profit booking. So you might see the markets, the Nifty, which hit the 18,850 range a couple of days, a day before yesterday, I think could now head towards the lower end of the range. So it could be a day of a pullback when you would want to buy at lower levels, closer to 18,650, but I think buying maybe more stock specific.
Okay, and Shrikant, morning. Let's get your trades as well. The index first.
Yeah, good morning, Survi. I think, see, the way the market is spending time very close to its all-time high of 18,800, 900, it is losing its strength. And even if we see the market is crossing the levels of 18,900, then we will see some short covering. But otherwise, we are expecting market to come under some profit-taking pressure. That's the overall view. But yes, on intraday basis, if we see any quick drop to the levels of 18,680 or 650, which was its previous lowest level, then there we should look for adding some long positions because it's a support of 20 days simple moving average. From there, again, we can expect rebound in the market. So close to 18,650, 660, we should look for adding some positions with the stop loss at 18,600. For the Bank Nifty, 43,000 is the level, and there the Bank Nifty is having excellent support. In case if we see any rebound, then close to 44,000, we should be selling.
Okay, all right. Morning, Shrikant. Morning, Mitesh. Shrikant, you go first. Tell us, what are the individual stocks you're tracking?
Yeah, I think a few IT stocks are really doing well, and most of them are trading above their important resistance level. Specifically HCL Technologies, which was consolidating below the levels of 1150, 1140 for a longer time. Now it is consolidating above the same. So from here, the stock can move to the levels of maybe 1210, 1220. So HCL Tech is a buy at current levels with a stop loss at 1140. And the stock on which we are bearish is Bajaj Finance. Currently, it is around 7,030, 7,020. From here, the stock can again fall back to the levels of 6,700, where the stock has spent a lot of time. So at current levels, Bajaj Finance is a short candidate with a stop loss at 7,100.
Mitesh, what would your trades be?
Morning, Prashant. I have a mix of buys and sells today. Buy on Jindal Steel with a stop at 573 for targets of 605. Also a buy on Tata Chemicals with a stop at 990 for targets of 1,040. And on the selling side is ABB. I think after a good rally, the stock is getting bought and could see some kind of profit booking. So sell here with a stop at 43.20 for targets of 41.70. And Astral Limited is a sell with a stop at 19.80 for targets of 18.75.
Got that. Mitesh, thank you very much. Gentlemen, for the picks, we'll come back to you once the market opens, get some more ideas going. Right now, a very quick break. We'll have the pre-open rates when we come back. And we'll also get chatting with Peter Maguire, CEO, XM Australia. We'll talk about this huge fall in crude oil prices that we have seen overnight.
Welcome back. This is Open Exchange, and we're coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, in the next few minutes, we'll be getting the pre-open rates, but for the time being, I think it's a good time to get in some derivative strategies. Manoj Muralidharan, VP Derivatives at Religare Broking, joins us to tell us exactly that. Morning, Manoj. Before we get off to the weekend, we've got Friday. So we'd like to know what strategies you have for us, Manoj.
Good morning, Nigel. I heard that you're in the studio, and it's good to have that vibrant view that you have. Now, Nigel, unfortunately for the index, it doesn't go that way. What the biggest thing or the biggest folly I would say right now with the Nifty is, I guess this is for the first time since I've been trading into the market. I'm seeing that the Nifty intraday, at least the intra-month positions have not gone beyond a 1 odd crores. And in derivative, the maths is simple. The momentum in any underlying is proportional to the position, which is your open interest. So a lesser positioning in the Nifty for this month of June, and now the rollovers have started into the July series. So if we do not really inch beyond a 90 odd lakhs into July contract, I'm afraid July might be into some correction. But as of now, till the time we are above 18,600, things are fine, because 18,800 strike, where we have seen good amount of call and put selling, that is at a combination of 200 odd rupees. So we believe this range bound session in the Nifty might go in. And the only cautious thing I would say is yesterday also the Nifty managed to carry almost 7% shorts into the June futures, and we have still 4 to 5 days for the expiry to go on. So intraday 18,700, that is the pivot for the day. If the Nifty breaches that, then I'm afraid we might be inching more towards an 18,500. So as of now, 18,700 as a support becomes a good buy. Keep a stop loss of 50 points. The target should be again somewhere close to an 18,800.
Okay, Manoj, hi morning. What about stocks?
Stock specific, IT and metals have been selling, and we believe that unfortunately it might do that. Pharma is possibly one sector where we might see some respite, that is against the negative trend if there is any on the index. So we believe that Cipla at 990 should be a good stock, good support. So that's a level where you can go buy that with a stop loss of 985. Again, the target should be somewhere close to 1,015 on that. And from the IT, Tech Mahindra stands out because we have seen good cash positioning almost at 1110. So we believe that that's a good level to go long with a stop loss of almost 1080, and the target can be around 1160 on the stock.
Okay. All right, Manoj, thanks so much for joining in, giving us your take on the index as well as a lot of stocks, and look forward to catching up with you soon. Well, let's move on then. Surbi joins us to run us through a stock that she's tracking, which has been moving with some momentum. Surbi, take us through that stock.
So the stock on my list on the Momentumizer segment is Max Life Insurance, now Max Financial Services. Now life insurance stocks have been seeing an up move in the last 1 week or so, and Max Financial is also seeing that. In the last trading session, it was up about 3%. In the last 1 week, it is about 14%. The delivery and the traded quantities are also pretty strong. The traded quantities in the last week was 4.4 times the 5-week average, and the delivery quantity as well was 3.2 times the 5-week average. It has been making higher highs for the last 3 days, and the key triggers for the stock going forward is that Axis Bank is going to has to acquire 7% additional stake in the company. So if that goes through, you can see another you can see the stock making new highs. Also, the total business premium for the month of May was up 8%, and the FY24 premium numbers are going to be better than what the expectations were. So, I think Max Life Insurance is going to see an up move today.
All right. The Max Financial stock had been, since the rally began, a big underperformer, but very fast, very quickly over the last 2 days, with the 10-11% rallies, it's kind of caught up. Not completely, because it did, poorly as compared to the other stocks from the start of the year, actually, even before that. But some part of the underperformance has come back, has been corrected. Surbi, thanks very much for that. With that, Siddharth is still with us. Siddharth, any thoughts? Max Financial, do you have coverage?
Yeah, Prashant. So we do have coverage on the entire insurance space, and as rightly highlighted by Surbi, there is some interest coming back into the space. The sector has been underperforming for quite some time, initially because of the COVID-related increase in cost, and then the sales pressures because of the work-from-home culture. And then we had the government in the budget bringing in some measures which kind of deterred the investor sentiments towards the entire insurance space. But if you look at the monthly premium collection, which is now started to seeing some improvement from about a decline of 2% in April, May saw industry aggregate premium collection grew almost 10%. This kind of led to a positive sentiment change towards the entire space. Looks like the worst is behind for the sector. within the insurance space, we like SBI Life, which has been a market leader. It has maintained its cost leadership, and we see the growth of about 20% in the APE compared to a Max Financial, where we are expecting a 15% APE growth. So based on that, we prefer an SBI Life. We have a buy rating and a target price of about 1,500 within the insurance space.
Okay, all right. So that final question before we let you go. SBI cards, there was the card update that normally comes, and it's coming for the month of May. The number of cards have moved up. So in terms of number of cards, the market share has gone up a little bit, but spends have come down. Any view on the stock from here on?
Yeah, Nigel. So I think it's a bit of tricky stock now with the numbers for the monthly data not giving a good read through for the company. But if you look at also in the other larger space with the UPI getting penetration through credit card as well, I think the overall outlook with the Q4 numbers also being not that strong, it has a mixed quarter. I think it's better to stay away for some time until the clear growth is visible for SBI card. So I think I would not see much of positivity for SBI cards, at least in the near term, with the kind of monthly volumes, monthly data that has come in for SBI cards.
Okay, all right. So we'll leave it there. Thanks very much for your time. It's always a pleasure having you with us here on CNBC TV18. Now, there's 10 minutes to go for the market opening. The pre-open is well underway. We'll have the rates up. I think we are down a little bit more as compared to what the SGX was indicating. Or not really. It's settling down in the same region, down about 30 points, so 18,740 or so. Remember, the level on the spot Nifty to watch out for is 18,660. As I was saying in the morning, earlier in the morning, that's basically Tuesday's low, Thursday's low, and the 20-day moving average, simple moving average, also comes in at 18,660. And a defense of that would be good. Under it, I mean, I think at least for the time being, you'll have to throw up your hands and say that perhaps the move is done for now and we should be prepared for a slightly deeper pullback. So we'll watch. It's not very far away, by the way, with this 30-point lower open. Peter Maguire is with us, CEO, Exim Australia. Peter, good to have you with us here. Good morning. Thanks very much for your time. Let's just start with what oil's done. And we're getting these large 3-4% moves up and down more frequently now. Kind of indicating confusion,
Prashant.
Peter, about the outlook?
Well, I don't necessarily think it's confusion, Prashant, and good morning, greetings from Sydney. But I'll tell you what, it's offering so much opportunity to traders. It's just been quite extraordinary. As you mentioned, the big 3 and 4% moves, all of a sudden it's up, then it levels off, and we think, well, maybe you're going to see another leg up, and then all of a sudden, it's sold off. And this has been a constant theme over the last couple of weeks, and maybe that's where we're at. We're just in that channel trade from the high 60s all the way through to, say, 74, 75 for WTI. Brent, had a couple of bucks to it. And it's hard one to work out. I mean, at the moment, it's offering opportunity, and that's what traders want, up and down. But, if you're looking at a long-term horizon, it's hard to put a pinpoint number on it.
All right. Hi, Peter. You're a fewer hours to the weekend than us. Just a few hours out there since you're in Sydney, as you mentioned. So cheers to that. Yes. But, from an India perspective, crude is rather important. So do you see, do you see prices dip further on from here? I mean, if you're looking at a broad range, what could it be? Say, by the end of this year, where do you see it settle?
I'll tell you what, Nigel, that's 6 months out, and it's hard to pick 6 hours out at the moment. But I'll tell you, well, it is, because there's so much volatility, and this is the great curse for traders. I would think that you should be higher from here, quite simply, but I'm worried about global growth. I'm worried about, geopolitics. There's so many different components that go into the equation, weather outages, hurricane seasons, all these sort of things that can impact price and price significantly. So I've just got to say, I don't think it's going to go. I thought 70 would be the low point, but let's say 65 could be a low point. I still believe it's, $80 to $90 to the upside. So anywhere in that sort of zone, I'm worried about US dollar, I'm worried about rates, inflation, all of these components also. So, hard one to forecast 6 months out.
Okay, got that, Peter. Hi. So you're not seeing it go too much higher. If you just leave out for a second all the factors that you mentioned, wars and hurricanes and all of that, we purely look at the market in terms of demand and supply, then is this a evenly balanced market, or is it a tight market given the kind of cuts that the Saudis had announced a few weeks back?
I personally think it's probably tight, and due to Saudis and due to overall the overall situation. So I think from that side, and I won't be surprised if you see further cuts from Saudi sometime in the third quarter. So that's something to hang our hat on. And I think that they're going to be fairly dynamic. So they want higher prices and to push the OPEC price up. So from across their members. So there's that point, and that's where I'm thinking at the moment. So yeah, I'm saying it's tight, and I'm saying that I won't be surprised for it to be higher than where we are at the moment.
All right, Peter, we'll leave it there. Thank you very much for joining us for that quick view, sharp views. Appreciated always here on CNBC-TV18. Thanks very much. Well, that's Peter Maguire from Sydney with comments on oil and metals. Mitesh is here. There's 5 minutes to go for the market open. Mitesh, I reckon on the Nifty, you'd still want to kind of stay away. But what would your 9-10 calls be?
That's right. I think the index is not showing any sign. So on the 9-10 call, we'll look at Jindal Steel. Buy with a stop at 573, targets of 605.
Okay, Mitesh, got that. Keep that call in mind. Well, it's 9:10 and the SGX, the actual pre-open Nifty is down by about 30 points. That's what we're getting. Better off than a lot of the other regional markets. Remember, they are down between 1 and 1.5%. So this is not a bad looking screen if indeed this is how we start off. Well, let's bring in Vivek because MSCI had its 2023 annual market classification review yesterday, and it has finally not included South Korea in the list. Vivek, I'm seeing those, what was it, 26 point something, almost $27 billion go away that were coming to us, that we were hoping will come to us.
Well, you're absolutely right. But, we actually saw the entire, document. And at this point of time, it does appear to be a delay rather than, an outright denial as far as, South Korea is concerned. So just, going through the entire development once more. So what's actually happened is that MSCI has not included South Korea on its watch list for a potential market reclassification from an emerging market to a developed market. So, but however, what MSCI is saying is that they've welcomed all of the proposed measures that the Korean market has done in order to increase the accessibility to international institutional investors. And what they're saying is that they will be monitoring the implementation and effectiveness over a period of time. Now, way forward, what we understand is that, there is a possibility of the index provider, that is MSCI, actually floating a consultation paper towards the later half of this particular year itself in 2023. And if the required reforms are actually implemented by South Korea, it could be added to the watch list as early as June 2024. Earliest likely inclusion, could be in June 2025. So, definitely there is a delay. Now, talking about the India impact, actually there is no impact. It is the status quo. The likely flows that we were discussing yesterday at this point of time appear to be pushed out.
I can see dollar bills with wings flying away from our shores, Prashant. I can actually imagine this happening. Very disappointing.
Very visual. By the way, there won't be as much disappointment in South Korea as there is.
That is true. That is true.
All right, well, Vivek, thanks very much for that. But that was an interesting development and, didn't materialize, but we'll keep an eye. Paytm is the one which is in focus next. Stock's done very well, but I think there is a bump up to its price target from one of the brokers. Abhishek is here with more. Abhishek.
Well, Bank of America has written on Paytm. They have buy rating and target price has been increased to 1,020 per share. They say that Paytm is up 63% YTD versus Nifty gain of about 3%, mainly on the back of improving business momentum. However, it is still down from the IPO price of 2,150. So they expect the business momentum in high margin lending and soundbox business to remain good at least for next 3 to 4 quarters. And they see upside risk to consensus estimate on earnings momentum. And for them, the FY25 EPS is a minus 3.9 per share, and FY26 EPS is at rupees 5.3 per share, which is an increase from the earlier recommendation that they had. So earnings momentum will remain strong. Now watch out for the PhonePe as well as JFS is what they have mentioned in their note. Back to you.
Okay, all right. Abhishek got that. So Paytm on our list as well. There's also Voltas, where UBS has come out with a view. We've got Surabhi joining in. What's UBS saying on Voltas?
So UBS has downgraded Voltas and to neutral, and they have cut their target price as well to 840 from 1200 earlier. They say that industry blues continue to persist with competitive pressure and unseasonal weather. The company has been losing market share, so to regain market share while scaling up the operating margins seems like a tough ask. They believe the rising competitive pressure will put pressure on their margins as well, and they cut their FY24 and 25 earnings by 22 and 31%. What worked in the past for Voltas was the asset-light model, which they do not see it working in the future. And for Voltas, it's largely a game of market share versus margins.
Okay, got that. So, Rabia, the stock's down about 1.5% in pre-open. Business has not been good. We know that. Thanks for the update. So, a lot of these consumer durable players, especially on the the AC side, etc., not having the best of the summer months. We should be getting our rates any second now. There we go. The bell goes, and we are off to a negative start, 20 points lower. So it's not very bad. The question is, where does it go from here? The mid-cap index is down in step with the Nifty as we kick things off. The bank Nifty is also down in an equal measure, down about, just 0.25%. So all your key indices, Nifty, mid-cap, bank Nifty, all down just about 0.25% right now. That's how the day has opened up. What is taking it down? Okay, so you have a mix of names, and it's cutting across sectors, really. Infosys on the lower side. Let's look at tech first. What's happening to TCS? TCS is absolutely flat for the time being. If you look at Tech Mahindra, it's down about 0.5%. Wipro is, well, absolutely flat. So IT is flat to mildly negative. Where else is the pressure coming in from? Some of the metal names like Hindalco continue to be weak. Adani Enterprises and Adani Ports, two of the Adani stocks started off on the lower side. Bajaj Finance and FinServ, both down about 0.5% to about 1%. And then we come to the financials. So Axis Bank, SBI Life, HDFC Bank. These are some of the names on the downside to begin with. Reliance is not helping the bull's case. Right now it's dragging its feet, lower by about 0.5%. What's trying to hold things up on the other side? Two giants, Asian Paints and ICICI Bank. These are the two stocks. But again, gains are very sort of skittish. Asian Paints is up 1%, ICICI Bank not even up 0.5%. So let's see. This is mid-cap index already, Nigel. Mid-cap index is now slipping a little more than the Nifty. So tentative start.
Well, that's right. Tentative start should be is what we're seeing. But a couple of large trades took place, and I think some of those stocks are reacting. Landmark, we had the management, I think the last 10 days on the channel, and we were wondering the stock was under pressure. I think there was a selling overhang, and that block has got cleared out. So that stock opens with a gain of close around 5%. Sterling Wilson, we had a big large trade that took place out there as well. So that stock as well, it should come up for you on the screen. I think there was some green to kickstart trade. Ease My Trip, I think there was a block of more than 5 crore shares in pre-open itself. So Ease My Trip is another stock that should come up for you on the screen. From the other names that are moving around, Vodafone Idea, yesterday it got slammed, it's come back. Brokerage Properties as well, one of the top gainers on the F&O list. While on the flip side, HPCL, that's down 2%. Shriram Finance as well, down close to around 2%. And Voltas reacting to that brokerage note, I think, that's down close to around 2% as we speak. We're moving towards 18,700. Remember, the line in the sand is 18,660. That's the low that we hit earlier this week. Last week as well, we visited that level, and it's the 20 DMA. So keep an eye out on that. If we're looking at broader market stocks, well, Mana Infra, they won a 680 crore order, and I think the street likes that. Stock is up close to around 3%, outperforming in otherwise wobbly broader markets. Prashant.
Well, so just under 18,700 now, but this is the first 2 minutes, so keep a watchful eye on the proceedings from here on. By the way, market breadth right out of the gates is negative. So you got more stocks down than up, and that is unusual. Usually we start with, 2:1, 2.5:1, 3:1 kind of advanced decline. But this is on the negative side. And yesterday, after many, many sessions, we had a decisively lower close, so 1% close, lower close on the small cap index. Now, on the downside, just a few other names. HCC is coming up with huge volumes. It was up some 15-16% yesterday. There were lots of large blocks, but no large there was some expectation of marquee names being involved in the blocks, but I don't think there was anything. Volumes yesterday were the highest ever. So stocks down about 4%, 20 odd rupees on that one. Shriram Finance is down about 2%. It'll come up on your screen, 1682. So Shriram Finance and Piramal, by the way, have been doing very well. Piramal, of course, pulled back yesterday. Shriram Finance is pulling back today. Varun Beverages is down about 2%. Voltas, of course, at UBS downgrade. We highlighted with Surabhi earlier, 2% down now. Hindalco is down about 1.6. ONGC starts about 1.6 lower. HPCL is down 1.8. Zomato, we mentioned, down a little bit. APL Apollo, Ather, Tech Mahindra, Zomato are some of the other names which are down to begin the day. It's again early, but for what it's worth, the advanced decline is full 2:1 in favor of declines as we begin this session. A few names on the upside. Landmark, which is the dealership for premium cars, 4% higher on that one on volumes, by the way. BSE starting with a 2% pop. It did well yesterday. And Tube Investments is another one which is starting higher at this point in time. So more in just a bit from now. The market is down about 70 points. So 18,700 or so is where it is trading at. Krishna Kumar Karva is Managing Director at MK Global. He's joining us right now to talk to us about what he makes of the market. Mr. Karva, thanks very much. Good to have you with us here. Is this up move, Mr. Karva, maturing? I mean, I think that's the question to ask, because optimism, a little bit of exuberance maybe thrown in, stock recommendations flying all around. These are classic signs. But what do you make of it?
See, I think in the last 3 months, you had a lot of macro positives. Inflation, overseas and locally. So those kind of positives have kind of played out. And plus, you also had massive inflows, basically because, emerging market investors were moving out of China and looking to invest in India. So all those macro positives have kind of possibly played out, and indices have moved up by, say, around 10 to 12% as far as the large cap indices, and maybe the small mid cap have moved up by 15-20%. The stocks also having recovered brilliantly in the last 3 months. So my sense is that natural time to take a breather, and that is what possibly we are kind of seeing in some of the stocks or even in the indices. I think now what is required is obviously the stock-specific micros, how they behave and how the first quarterly numbers and how what is the commentary of various companies once they start giving their first quarter numbers and outlook. I think that is what is going to be important for the market to further move up. Also, if you look at it, I think the banks, the top 2-3 banks, private banks, which have been having stellar performance, but somehow the stock prices are not reflective of the strong fundamentals. So that also is keeping the large cap index under control. So yes, time to take a breather, time to consolidate. And as you rightly said, that too many stocks, the breadth of the market, at least till a few days ago, was massively positive. And there have been so many blocks which have been offered. I think last month, almost 40,000 crores worth of blocks. Now, the question is, the insiders, the PE fund, the promoters, they sold and public market investors have bought. Time will say who was smart.
Absolutely. We've been having this debate internally, Mr. Karva. And Nimesh has been telling us all about the blocks. And even on our digital show, this is exactly the point that we've been raising. Who is the smarter one, the buyer or the seller here? But the buyers are, not just retail investors per se, but a lot of institutions. You could argue it's still retail because mutual funds are buying. At the end of the day, the last man or woman standing is the retail investor when mutual funds buy. But let's see. I think the jury's out on this one. What's becoming clearer is the decline is, by the way, accentuating. I just want to point this out before we get back to the conversation. 18,688, 690. So bulls are finding it tough to hold on to this 18,700 level. The mid-cap slide has deepened. Look at the difference between the Nifty and the mid-cap index. On Nifty is down about less than 0.5%. The mid-cap index is already down 0.8%. So, yeah, there we go. So that is the cool-off, very clear cool-off. Started yesterday and it's continuing today. And that is the Nifty for you. The one sector that's really down, the weakest sector so far this morning is the metal space. Remember, China hasn't done any aggressive easing or any fiscal stimulus, which was exactly the reason why metals were rallying earlier this month. On top of it, other central banks are now coming in hiking rates, and that explains what's going on. Weakest sector of the morning, metal. Look at Hindalco, Nalco, SAIL, Tata Steel, JSW Steel, ferrous, non-ferrous. It's cutting across the lines. That's just a highlight from the morning action so far. Okay, some of those stocks coming up for you. Mr. Karwa, to get back to the conversation now, so what do you do in a market like this? Finally, the cool-off has set in. Now, are there any specific pockets where, let's say, you would advise if people have made a decent amount of money from March, that they should be taking some profits off, whether it is metals, whether it is any other sector, whether it is defense? Or would you be in the camp who would just stay put? Don't book profit, hold on to your stocks. So what's the right way forward according to you?
See, I think as far as booking profit for buying fresh is always a function of individual stocks and what is the kind of visibility you have for the next few years as far as earnings are concerned. My sense is that wherever investors feel that maybe more than 2 years of growth or numbers are being discounted currently, then the risk-reward ratio is not in your favor to hold on to those stocks and maybe could book out. And that should be the prime reason to book out rather than just because you have made profits and you should sell. That's not the reason to sell any stock. So it's a very bottom-up individual thought process in terms of how, whether it is just defense stocks or whether it's the banking stocks or auto, wherever you have made substantial gains. Going forward, what is your sense as far as the next 2 years growth outlook? And is it getting discounted? So that's the way one should be looking to book out. And yes, you should be vigilant as far as what you buy fresh, because please remember that you're also buying stocks which would have also moved up by say 30-40% in the last 3-4 months. So does it make sense to buy them now or wait for an opportune time? So yes, I mean, prudent investors have been booking profit. In fact, if you look at the mutual fund inflows also, the SIPs have been holding very strong, but the net numbers have been muted for the last few months. And that's precisely because bulk investors or lump sum profit taking has been happening as far as the investors are concerned, even in the mutual funds.
Hi, Mr. Karwa. Good morning. Nigel on this side. Mr. Karwa, what about the mid and the small caps? Because that's where the big party is taking place. The problem is, you always wonder when the party is going to end, and many investors will like to be closer to the door. Do you think we're still far from that euphoric stage? That was the consensus, actually. We have the editors roundtable that we host every Friday, and the consensus was we're still far away from those levels. Do you agree?
See, yes and no. I think the beauty about our small cap, mid caps is that once the door starts closing, everybody wants to move out and nobody is able to exit. So the prudent investor always believe that to sell when there is a good demand for the various stocks. So that is the way large investors are able to exit their positions in small and mid cap. Now, having said that, I think the whole mid cap, small cap segment is almost like, say, you can say 300 to 400 stocks, and every stock sub-sector has its own fundamentals, and there are a lot of positive news flows in various sectors, primarily in, say, capital goods and manufacturing and those kind of opportunities. So I think rather than taking it with painting everything with the same brush, I think it makes sense to be very bottoms up as far as selling in small cap, mid caps is concerned. So it all boils down to bottoms up thought process. Is there an euphoria? No, I don't think so. There is an euphoria overall in the market because I think investors were caught unaware. So I think March and everybody was, there was blood on the street. And then suddenly, I think April onwards, the market picked up. I don't think so investors were able to buy fresh into the market. So most of the gains are basically a portfolio gains in terms of whatever you held on to. I don't think so big investing has happened as far as fresh money into the market. So to that extent, yes, there is kind of a left out feeling. And if there are corrections or stock specific, I think there would be more buying than selling coming in. And in fact, it's a very prudent thing that the retail investors who invest in mutual funds, they have kind of booked profits in the last few months. I think they themselves would be coming back to invest in whenever there is a decent correction in the market. And if you see, I think the small cap, mid cap funds have seen the maximum inflows also.
Got it. Mr. Karwa, it's a pleasure, sir. Thank you very much for your time. Lots of wisdom there. And it's always a pleasure speaking with you and having you here on CNBC TV18. The market, by the way, is down a full 100 points. Very close, by the way, now to the 20-day, which is at about 18,660, just 15 points off it. Now, the big, of course, talking point has been Prime Minister Modi's visit to the US. India and US are hoping to forge a deep partnership in emerging and critical technologies, with semiconductors being a priority. Let's cut across to Shireen Ban in conversation with the IT and Telecom Minister Ashwini Vaishnav to discuss the key outcomes and announcements from there. Shireen, over to you.
Well, thanks very much. Greetings here from the US, where Prime Minister Modi is in Washington, D.C., has addressed Congress and, of course, the state dinner underway. But the sum and substance of what has emerged at the end of this state visit that the Prime Minister has made is the fact that there is a sense of urgency to foster a deeper partnership, especially when we talk about areas of defense and we talk about areas of technology, and within technology, emerging and critical technology also, including semiconductors. Joining me now is Minister Vaishnav. Minister Vaishnav was in fact here ahead of the Prime Minister's visit in the US, meeting with his counterpart and really setting the stage up for the kind of announcements that we've seen coming in. Mr. Vaishnav, many thanks for joining us here on CNBC-TV18. Appreciate your time. For the benefit of our viewers, I'm just going to run very briefly through some of the key announcements that have come in. Micron will invest over $800 million towards a $2.75 billion assembly and test facility in India that is in phases. Applied Materials will set up a semiconductor center for commercialization and innovation, and Lam Research will train about 60,000 Indian engineers through its Semiverse solution. Just some of the highlights of the announcements that have come in. Mr. Vaishnav, let me start by asking you, first, on the broader partnership between India and the US. The ISET is already operationalized. That is the understanding that the two sides have as far as critical and emerging technologies are concerned. How much progress has been made on that front?
Shireen, this is a very important milestone in our journey towards developing the semiconductor industry. As you are aware, we have taken a very comprehensive outlook. Instead of forcing through a fab, we are focused on creating the ecosystem. It's very important that we create the ecosystem so that the industry can grow sustainably. So this the announcement of Micron to set up the first semiconductor unit in India is very important for us, and simultaneously the announcement from Applied Materials to set up the engineering center so that those complex and sophisticated equipment which go into the semiconductor industry, they can be designed in India, they can be made in India. And the focus on training, focus on developing talent. So Lam Research will be using their state-of-the-art Semiverse, which is a virtual reality-based system, to train 60,000 engineers into manufacturing semiconductors. So this is a very good endorsement, and I'm very glad that Prime Minister Narendra Modi's visit has led to this major development.
Mr. Vaishnav, if I can address each of those announcements individually, and let's start by talking about Micron, because that is the big one. There will be a component of what the center puts on the table, which is about 50%, and what the state government in the state of Gujarat will put on the table, which amounts to about 20%. Can you explain the structuring and the contours of the incentives, how they will be rolled out, and what it will eventually mean, both for the center as well as for the state government?
Our semiconductor program, right from the beginning, had a very clearly defined structure for giving the incentives. See, this is a new industry. This is a very complex industry, and this has a great impact on the way our economy grows. So right from day one, we were very clear to learn from whatever sources we could learn all across the world, the experience of the world, and our experience of the past. So we decided to structure it in a way where we will be giving the incentive pari passu, a dollar for dollar, whatever investments they make in the construction of the facility, getting the plant set up, getting the entire ecosystem set up, that same amount we will be putting in the plant. The government of Gujarat is topping up that incentive through its own cabinet approved policy. So this is going to be a very important milestone. See, what's important is, when the first plant comes, the chemicals which are required in the semiconductor industry, the gases which are required in the industry, the equipment manufacturers, the entire ecosystem of logistics which is required, it's a very precision kind of industry all that starts coming, and that sets the stage for the entire industry to grow. So we are very hopeful, and we are very we have very high level of confidence that we should be seeing 2 or 3 major announcements in the coming months.
Okay, 2 or 3 major announcements is what you're anticipating. I'll get to that in just a second, but let me address the Micron issue, sir. When do you expect the facility to be operationalized? What's the indication given by the company? And also, what is the approved capacity that's been cleared for Micron specifically?
So land allocation has been practically done. The design for the plant is practically frozen. The construction agencies are getting finalized. So we expect that within 6 quarters from now, the production should start. As you know, Micron is the leading memory memory manufacturer in the world. So a series of products in the memory value chain, they will all be manufactured here. And I wouldn't be able to put a full complete number on which particular memory will be how much capacity, but the overall, when the plant ramps up to its full production, the revenue from the top line, the turnover from this plant will be of the order of $1 billion per annum.
Okay, $1 billion per annum. Let's address the 2-3 big announcements that you said we should expect. How soon can we expect those? And are you suggesting that you are in talks with other companies? There was a lot of speculation on whether the likes of Intel are in dialogue with the Indian government. Are we likely to see some other large semiconductor players looking at investing in India? Is that what you're suggesting we should look forward to?
Yes, that's correct. I wouldn't like to take any names, but there is very good interest. So let me put the entire context. The semiconductor industry is growing from $650 billion to $1 trillion over the next 5, 6 years, 7 years. That's the kind of growth which the industry is seeing. The talent that will be required is of the order of 1 million new talent required in this industry. Where is that talent? That talent is in India. Where is the focus on ecosystem? That focus on ecosystem, making sure that the logistics, the power supply, the water supply, the chemicals, gases, design, everything is put in place in a very comprehensive program. That's coming in India. So when I met about 45 companies in US in the semiconductor industry, ranging from equipment manufacturers to fabs to design to software to people who are consulting with the semiconductor industry, each one of them very clearly said that India's approach is the right approach, and this is the approach which will create the next big semiconductor industry in the world. So we are very, I mean, the entire approach is very methodical. The entire approach is not to rush through. Entire approach is to focus on creating all the pieces in place, setting all the pieces in place so that the industry can grow over the next few decades.
Okay, Mr. Vaishnav, since you're talking about building out this industry in India and you believe that this is the opportune moment for us to do so, you've also got a situation at this point in time where the US is hoping to ramp up manufacturing capacity here. The US has brought in the CHIPS Act, which is $50 billion and more in terms of incentives. So are we likely to see the Indian government up the incentive program? Is Semicon going to be bolstered further? Are we likely to see more incentives being rolled out to try and draw in future investments?
See, India and US have complementary strengths. The way we have structured it, and this was reflected in the MOU that India and US signed when Secretary Raimondo had visited India, and now that is further bolstered during Prime Minister Modi's state visit to US. There is a clear and a thought-through approach towards developing semiconductor industry as two partners. This entire industry has various segments. Some of the segments US will focus, some of the segments India will focus. There will be many areas in which the manufacturing happens jointly between India and US. That is the approach we are taking. There will be many areas where research and development happens jointly between India and US. there will be talent development programs which are jointly taken up. For example, our MOU with Purdue University, our MOU with the Lam Research, right? All these point towards a very clear partnership where both the countries are able to add value to each other's program. See, the amounts will all depend upon the progress of the utilization of funds. As the first tranche of $10 billion in India gets utilized, we can look at further support to this industry. And also, as we have seen in many industries, after the first setup happens, then the industry also takes its own momentum and things move in a totally new direction.
All right. Well, that is the exclusive conversation with Ashwini Vaishnav, and a very interesting conversation around setting up, the base, the building blocks for the semiconductor industry here in the country. You can actually catch the entire interview, on YouTube. The entire interview will be there, and of course, we continue to play the snippets from the interview all day here on CNBC-TV18. Well, just a quick word on the market. We, by the way, broke the 20-day moving averages. I just wanted to make a quick mention of it. At the day's low, we hit 18,655. So very briefly, but we're right there at the 20-day moving average, and it doesn't look very good. The 20-day has been, because the market galloped very fast, very high, and it's now come back to those levels. But that remains the important trailing reversal stop level for kind of positional trades out there. So under the 20-day, but you need to see a close, a day, 2 days, but you need to see a firm close under it. And I think that will indicate that perhaps this move, the up move, is maturing, it's close to it, maybe it's already done, and we should be ready for a slightly deeper kind of pullback. Surabhi.
Okay, that's the market. So we need to be watchful of those levels, and we'll keep an eye out on the ticker. But let's also continue with our corporate conversations. Now we're focusing on GIC-RE. The company's FY23 performance did improve as the underwriting losses have declined. However, the question is on growth and growth in premiums and what the current year can throw up for this company. We have Mr. Srivastava, Chairman and Managing Director at GIC-RE, now joining in. Good morning, sir, and good to have you on the show. So FY23 was very interesting. If we look at the underwriting losses, then they've improved dramatically. I think they've halved, if I see the right numbers, to just about 2,200 crores. But the market wants to know, what about premium growth? Because for the year as a whole, your gross premiums were, I think, down somewhere around, in the mid-teens. Can you reverse that decline in premiums this year? And if yes, then which sector do you think can fire for you? Motor, fire, which is that sector where you see growth coming in?
See, the trade of reinsurance is one that is extremely balanced, and, we have very calibrated measures in whatever we do. So what you see is happening today is not that it happened overnight due to our assiduous efforts over the last 3 years. And that is how the trend is now visible in what we are trying to do. The commitment was that we will try to bring down our combined ratio, which is essentially translates into improving our incurred claims losses, which is what has happened. In the process, you had to prune your portfolio. There was a lot of baggage that GIC was carrying, which we shed. And the pruning of the portfolio and making the underlying portfolio healthier is what translated into this improvement that you are seeing visible in figures today. Now, as far as premium growth goes, for a reinsurer, growth in premium is never a problem. You want me to double it in the next 6 months, we will do it. But with doubling of the premium will come tripling of the losses. A reinsurer does not want it. It is very easy for a reinsurer to do that, but then the losses is what a reinsurer should be mindful of. Exactly the part that we have chosen to tread on, and that is getting the bonus to us. Now, as far as the growth is concerned, we have seen an amazing hardening of the market by almost 25 to 30, 40, 50 risk-adjusted rate changes that have occurred in the market. And these rates have really proved to be, giving us the tailwinds necessary for having now achieving growth with profitability. That is what our endeavor is going to be in future, and that is the way GIC-RE is going to move forward as a national reinsurer.
Mr. Srivastava, good morning. No specific numbers then, right? The momentum for you will depend on how the underlying insurance industry does. Would you want to put any numbers to it in terms of premium growth for 24?
No, not really. We wouldn't really want to put a premium growth because growth is important, no doubt. But then the underlying profitability of the portfolio for a reinsurer that gets you balance is more important.
Got it.
Okay, can I, Prashant, can I just ask about the other end of the spectrum? So you're not giving us a premium growth number, but the fact that you're on a very consistent path of reducing those losses, which have halved. You're at 2,200 crores of underwriting losses in FY23. What happens in FY24? How much lower do you think you can bring them to?
The reinsurer's worth really is measured by the combined ratio. Combined ratio essentially is in what you earn to what you spend. Currently, we are at 109. So put very simply, for every 100 rupees of premium that we are getting into our kitty, we are spending 109 by way of claims and commissions and expenses of management. Expenses of management is never a problem for GIC because at 1%, we are possibly the lowest in the world. That leaves your claims, what is to be, tightened up. We are at 109 today. The idea is to get to 104 and then finally to be as close to 100 as possible. So that should give you a fair measure as to where we are moving.
Mr. Srivastava, thank you so much for joining us. What I wanted to understand also, you spoke about combined ratio at 109. Could you give us a bifurcation in terms of what's the combined ratio on the international side of the business and what's on domestic side of the business?
Right. So if you see the split that we have between our international and our domestic book, and first, why a split at all? Because the basic tenet of reinsurance is spread. I mean, very simply put, that your premiums from America will offset your losses from Australia. That's how a reinsurer balances his book. So our ultimate goal is to have a 50-50 book, 50 domestic, 50 foreign. Currently, we are at 70-30, which is where we stood at 31st of March 2023. But now when you look at how we have tackled the domestic book, which was easier and being home turf, we were absolutely sure as to what we are doing. The combined for the domestic book is standing at 95, which is extremely heartening. So where are the 109 figure coming from? From our foreign book, which is what we are going to now pay a lot of attention to and have growth there with profitability as the mainstay. The fact that the rates have hardened, as I mentioned earlier, is going to help us a great deal in achieving this objective.
Just a follow-up question. You said that you'll be focusing on the international book. The combined ratio there is about upwards of 130. Now, of course, we've seen a hardening environment across the globe, including the foreign markets. With this hardening to continue or remain where it is and everything else remaining the same, in this current financial year, could you see a 25 to 30% drop as far as the combined ratio is concerned on the international book? Is that possible?
Exactly what we are working at. We are calibrating our entire efforts on the international book, and we'll be, again, shedding those portfolios, those treaties that we have which are loss-making and, trying to make the underlying portfolio a much healthier one. That is the endeavor for GICD.
Okay, one question as far as the price hardening itself is concerned, like domestic insurers have been complaining about this very aspect of price hardening. What's your outlook for the April cycle? Do you expect it to remain where it is or do you expect it to harden further?
See, reinsurance is a very cross-border trade. So whatever happens is not, India is not insulated to the globe. It's a global phenomenon that we are witnessing, and this hardening, the experts say, is going to continue for at least a couple of years more. So you would be expecting some rate hardening in the next April cycle as well. That is something that is going to flow in.
Okay, thank you so much, sir, for speaking to us and sharing your views as far as the company's performance is concerned. Back to you guys.
Well, Yash, thanks very much for that. And Mr. Srivastava, thank you very much for taking those questions. Appreciate you joining us with that. I mean, we don't hear from GICRE very often. There's flashes at the bottom of the screen, by the way, with regards to MCX. MCX is, there was a mock trading session which was supposed to happen on the 22nd. It's been the mock trading session has been cancelled. This is with regards to the technology agreement that MCX has with 63 Moons, which is expiring at the end of the month. So worries about whether there will be further delays with regards to this technology arrangement. And of course, transition to the new one. So we'll have more details on this one, but the stock has taken a bit of a dive. It's basically back at yesterday's lows. Yesterday also the stock had sold off and then come back to about 16 kind of levels. Well, the market's down 86, 87 points after just breaking the 20-day. Briefly, it's back up, but we're still on the day down so far. We'll take a very quick commercial break here. We are back with, of course, more market conversations, more market focus. We'll also have the management of MapmyIndia to joining in to talk about their business outlook and the 5-year plan that the company's laid out. A little after that, Ritesh Chandra of Vendors Capital joins in to talk about their investment ideas. Stay tuned.
Welcome back. Well, the markets are struggling a little bit, from the lows, though. We have managed to defend that 18,660 odd, which is the 20-day MA and the recent low as well. But let's move on to another management then who's joining us on the show. The management of MapmyIndia, that's the next corporate on our radar. The company has laid out a 5-year plan, accordingly, where they're targeting around 1,000 crores of revenue and expect $1 billion of addressable market by FY28. Rohan Verma, the CEO and ED of MapmyIndia, joins us on the show. Hi, Rohan. Good morning. Thanks so much for joining in. Always good speaking to you. Well, you have a goal of close to around 1,000 crores odd. Currently you're at sub 300 crores. All of this is going to be organic, or do you have inorganic plans as well?
Hi, Nigel. Thanks for having me. Yeah, these are all organic. We've quite simply laid out, the growth that we'll see by increasing our volume in automotive by 3x, in mobility with IoT by 10x, in the corporate world, volume of customers by 5x, and in the government world by 6x. So it's all organic, and other things will play out as they have to. But this is a quite simple path forward based on our bullishness and what we see already in the market, with more and more customers adopting more and more use cases of our wide product and platform portfolio.
All right, Rohan, just a quick question, then we get that. It's going to be all organic. You're looking at scaling up the business. Got that. Your IoT part of the business, I think last year it was around 20% of your business, somewhere in that vicinity, 60 crores odd. Could you tell us what is the scaling up plan of that? And also margins out there had improved from around 1% to around 4%. What's the trajectory in terms of improvement out there?
Sure. Thanks a lot. The IoT business is doing quite well. As you saw last year, it grew about 140%. And what we've said is in this 5-year plan, it will grow about 10x from where it is right now. And so it'll be a contributor to the revenue. The good thing about IoT, as we've said before, is devices are followed by high margin SaaS income, and these are recurring. And once somebody installs a device in their vehicle, then they continuously need the service for next few years. And so that creates stickiness. It also plays into the flywheel of our maps, where IoT device data actually helps further improve our maps. So it's quite core and strategic and interesting for our overall business. And of course, with scale, margins will also continue to rise.
Rohan, hi, morning. Just in a simple way, can you tell us, IoT was a reason for a lot of excitement a few years ago from a consumer B2C point of view, but I think where you come in is mostly all B2B. What are the most exciting applications of IoT as you're projecting this very large growth in that segment of your business? And through FY28, you will still be very much focused B2B, or are there any plans to get back into the B2C segment as well?
Thanks, Prashant. Yeah, if you look at the manufacturing story that is playing out in India, whether for consumption-based FMCG or consumer durables, or for just the industrials, all of it requires logistics. And in all of that, it requires our IoT and logistics SaaS solutions. So that's one use case where when any logistics, e-commerce or manufacturing company needs to monitor and optimize the movement of the vehicles that are moving goods, even an automotive company with components and spares, they all need our IoT. And if you, on the other side, look at the EV fleets, whether on 4-wheeler or 2-wheeler or even on the commercial vehicle side, all of them need to monitor and manage not just the vehicle movement, but also the battery status, battery health, powertrain status, efficiency of movement. So just these are two use cases. And then as you look to further improve safety on the roads, video telematics based on our IoT is becoming important, whether for buses or trucks or taxis, where people want to be able to know whose fault was it, or is the driver drowsy if an accident happens, or to prevent accidents. So these are just some of the use cases on B2B. And then to answer your question on B2C, definitely, there's a push within our company to, now that we've become bigger, stronger, and people are really liking our Mappls app, which is for consumer, saying that it offers many more features and many more capabilities around safe navigation or hyperlocal discovery and search compared to the incumbent default apps. So you'll see a bigger push from the company on the consumer side as well, aided, of course, by our Mappls gadgets, trackers, dash cameras, infotainment systems, which are also there for consumers along with Mappls app.
Okay, got that. Rohan, want to also talk about EVs, because you've spoken in the past that you do want to increase your penetration out there. I guess that business is slightly more profitable in terms of margin profile as well. Can you tell us what your EV plans are for this year? How much of the business will come from this sector, and what are you looking at ahead?
Thanks, Surbi. Yeah, EVs require more technology. They require more monitoring. Consumers need to address their range anxiety issues. They need to find charge stations. And so we provide battery efficient navigation. We tell you what is the most efficient route so that you minimize your battery usage. We tell you whether you can reach your destination or whether charge station is nearby. And we can monitor the health of the battery. So OEMs are working with us extensively on all their new EV launches, whether on the four-wheeler side, on the two-wheeler side, and most of the EVs that have come out in the market, we are already there. And we're also working with the EV fleet owners, again, on the four-wheeler side or two-wheeler side. So it's interesting. And as the EV market or segment rises, I think that will be another big driver where we are participating in and powering that growth.
Okay, so, give us a broad sense in terms of the business mix. You're saying 1,000 crores in revenue. In the past, you've said that margins should be at around that 40% mark. Do you retain that view? Or can margins get even better, perhaps, because you're looking at more EV penetration, and that's where, that's where the better margins are?
Sure. On the business mix, we have automotive customers, we have corporates, which are the digital economy customers, the big tech, the new age tech, mobility, e-commerce, fintech, as well as the traditional corporates across BFSI, FMCG, and the government as well, which is at local level, central level, state level. So there's a good mix of customers and market segments that we offer. With defense now, we are doing a lot more. In the drone space, we are doing a lot more when it comes to infrastructure development of the government. They are leveraging us for smart cities or road construction, etc. So the business mix is actually quite diversified. And we are very happy that we're able to participate and empower all the growth engines across sectors. In terms of profitability, yeah, we're a digital products and platforms company. So you continue to see high margins, 30+% PAT and 40% plus EBITDA. Our focus this last few weeks, as we did the Analyst and Investor Day, was really to be able to lay out all the different use cases and be able to communicate to investors what our customers and we see that there's a lot of growth and a lot of potential. And so that 1,000 crore plus milestone was kind of the key focus. And of course, profitability follows, being a digital products and platforms company.
All right, Rohan, we'll leave it there. It's always a pleasure having you with us here on CNBC-TV18, and we wish you all the good luck to you, your team, as you grow the business and achieve those F528 targets. Well, that's MapmyIndia, 70 points lower. So there has been a bit of a bounce after, a brief breach of that 20-day moving average. But, we are still down about 60, 65 odd points or so. So it's not one way, and that's good news. I think we have our next guest ready with us. Ritesh Chandra is managing partner at Avendus Capital. They're joining us right now to talk to us about late-stage investments. Avendus, of course, has been very active in that particular space. Ritesh, great to have you with us here. Good morning. Thanks very much for your time. Before I get to what you are doing and the businesses that you like, I mean, I think I have to ask you what you make of all that we've seen with Byju's over the last 24 hours or so, because that had been the poster child for some of the most marquee investors in any single company. And of course, we've seen lots of trouble over the last couple of months, culminating in what we saw yesterday evening, Ritesh. What do you make of it, and is there any broader impact on the ecosystem?
See, I think my knowledge is restricted to what I'm reading and what I'm hearing about it from the press. But I think it's clearly something which is an undesirable, leaves a bad sour taste in the mouth for investors, especially when there is, and I don't know which side is correct in this whole situation, but it certainly leaves any kind of even smell of misgovernance. Leaves a very bad taste in the investor's mouth. And that's something that I think is best avoided in an ecosystem which is just about evolving.
Mr. Chandra, hi, good morning. So let me just sort of pull back to the larger question, because I think in your fund, which is the Vendors Future Leaders Fund, I mean, you have a mix of investments. Some are listed, some are in the non-listed space. Overall, the non-listed space, before we talk listed, I want to actually talk non-listed, the private markets as they are called. What is the mood now? It's been a very sharp cleanup phase, if I could say, in terms of, there's no free lunch anymore, if I could put it that way. So what's the mood now? How are valuations looking? How are promoters reacting or behaving?
Interesting. So I think, I always like to call it FY22 and 23 was the hangover after the party of FY21. So we were kind of in a situation wherein there was a surplus of capital in 21-22, which was kind of finding its bets in new age companies. But I think what's happened after that is there are two things that have clearly happened in the markets. One, valuations clearly, as you articulated, have mellowed down. And the other thing that's happened is that there has been a clear stratification in the market, with market leaders and top tier assets still continuing to command attractive valuations. But what has changed since 21-22 is the fact that mid-tier assets or all the also-rans are not getting financing. And that's been a significant maturing of the market, if I may put that word. And that's something that's very, very healthy for the ecosystem, because the market is clearly still reeling out top dollars for top quality assets, but is very circumspect about other businesses.
Okay, let me ask you some more, just to understand the mindset right now that you have when you go about making these decisions. I think Licious is one of the companies in your portfolio. Now, there are quite a few recent listings in the public markets which are a play in the same space. We're talking discretionary urban consumption trends, right? Now, whether it's a Nykaa, whether it's a couple of others, you haven't opted for some of the public listed stocks here. But I mean, I do see Licious on the list. So when you're looking at this part of the market, which is where a lot of the excitement and maybe over-exuberance was, whether it is your Zomato or, the Swiggies and, all of these stocks and these companies, what are the filters that you are putting in place now when it comes to making any fresh call on investments? Would you look at any of the listed entities now where prices have corrected significantly from IPO time?
So two things. One is we are a category 2 AIF. So consequently, our primary focus is on unlisted investments and private market investments. But just coming to your specific query on D2C brands, I think, look, we've been very selective about looking at assets. Like you mentioned, Licious was one business that we have invested. We continue to be very actively looking out for businesses wherein we believe there's a structural or competitive moat around these businesses. Valuations, again, are very subjective, right, at a point in time. But as a concept, we still continue to believe that digital to consumer offers significant value for consumers and investors. And that's something that's been a focus area for us. Our analysis is always predicated on a mix of both understanding of competitive moats around the business as well as a fundamental value analysis. And I think when we look at a business, we look at it from a very long-term perspective, even though our fund horizon may be small, but the business has to have deep competitive moats which can outlive for the next 7 to 10 years at least in the foreseeable future. And we see some of these digital D2C businesses kind of ticking the box on that one.
Okay, so that's as far as the B2C brands are concerned. Leave us with some ideas, some thoughts. What are you liking at the moment? Where do you see opportunity where valuations aren't going, through the roof?
Well, India has never been a cheap market, so that's a given. But I think we are very excited about financial services at this point in time. And we are very excited about verticalized IT and digital services. And I think these are two focus areas for us as we go along. Financial services, largely because of the credit offtake demand, is very, very robust. We have the mess behind of COVID has been behind us, and we're seeing very strong fundamental growth come across in the sector in multiple pockets. And the other businesses, as I said, the other segment of which is a key focus area for us is verticalized IT and digital services. Anybody who's offering a value-added product or value-added service is of extreme interest to us, because we still believe that the IT services and the digital market has very strong legs to run on at this point in time.
Okay, I think I already have a theme for our next conversation. It's going to be generative AI and whether, we need to kind of brace ourselves for some exuberance here as well. The moment these fancy new technologies come, everybody wants to put an AI at the end of their company name, right? So I think that'll be a good conversation for the next time. Thank you.
Absolutely. Look forward to it. Thank you.
Thank you very much. We'll take a quick break on that note. On the other side, Mitesh Thakkar joins in. We'll go back to the markets and look at the technical setup now.
Okay, welcome back. The market's down, 80 points. Mitesh is with us. Mitesh, I know you're not trading the Nifty, but just comment on it. We had a brief breach below the 20-day at 18,660, and there has been a bounce. Typically, how does, first breach, does it hold, does it last, or there is a bounce and then some activity before a final break? How does it play out?
Prashant, we have actually taken a trade on the Nifty. I've taken a put trade, which is I've bought put options for the July series. 18,700 strike. The idea is that while we have kind of, managed to hold on an hourly close basis the levels of 18,650, today what is important is that we have had a gap down, which means that yesterday's low was higher than today's high. So I think a gap down with overbought levels, I think, does typically have a stronger probability of giving a bigger correction. So I suspect there is a chance that we might actually see a break of 18,650. And the stop loss is the gap level. So yesterday's low, which was around 18,759, 18,760 on this spot, becomes your stop. And there's a chance that we might actually see a trade to about levels of 18,550, and in the worst case scenario, even 18,480. So I have bought into some put options. Having said that, I think broadly, the gap down suggests that the next few days could still be choppy and could dictate more profit booking happening. Until we get past 18,760, I'll maintain a mildly negative view. On the stock side, I have one buy and one sell call. Bharti is showing very good breakout price and volume action on the intraday charts, hourly and 2-hourly charts. So that's a buy. Keep a stop below levels of 848. Look for targets of 880. And and then I have one sell call, and that's on Biocon. Biocon has something, which is broken below its key averages. The indicator setup is negative. So sell here with a stop at 241. And a target of 224 can be looked at.
Okay, well, more downside on the Nifty. Buy Bharti and sell Biocon. Those are trades coming in from Mitesh. Thanks very much, Mitesh. Speak with you soon again. By the way, market breadth is 4:1 in favor of declines. I mean, that is absolutely not something that one is used to at all. I mean, usually by this time it's about 2:1, 3:1 in favor of advances. It's exactly the opposite. But that's the market for you. We'll take a quick break here. It's the economy comes up with Lata. She'll get chatting with Ramani Dati of Teamly Services and Pawan Goyal of InfoEdge. We'll also have Shekhar Garissa of Foundit to discuss in detail about job hiring trends in the country. Stay tuned. That conversation comes up next.